The candles that look dead are the most valuable ones on your chart. Most traders scroll past them without a second thought. They are looking for movement. They are looking for candles that are going somewhere. And those flat, sideways, boring-looking stretches of price? They feel like waiting rooms. They feel like nothing is happening. So traders skip them, mark them as noise, and go looking for the action somewhere else. And then, a few hours or a few days later, the market explodes out of exactly that zone, and they are not in it. Again. Here is what the traders who missed that move never understood. Dead zones are not where the market rests. Dead zones are where the market loads. By the end of this video, you are going to know exactly how to read the one signal that appears inside every dead zone before a major move launches, how professionals use it to build the highest probability entries on the chart, and why the traders who master this signal stop chasing price forever. But first, let me describe what a dead zone actually looks like, in plain terms, because the trading industry has made this concept far more complicated than it needs to be. A dead zone is what happens when price stops trending in one direction and begins moving sideways. The candles get smaller, the swings get shorter. Price bounces between two levels, a ceiling it cannot break through, and a floor it keeps returning to without committing to either direction. On a normal trading chart, this pattern looks flat, directionless, inconclusive. Amateur traders look at this and see a market that has gone quiet. Professional traders look at this and see a market that is coiling, and coiled things release. The signal inside this dead zone, the one signal that changes everything, is called compression. Compression is not a complex indicator. It does not require software. Compression is the observable process of price squeezing into a progressively tighter range over a series of consecutive candles, while the volume underneath that range is falling. Tighter range, falling volume. That combination tells you one thing with remarkable accuracy. Neither buyers nor sellers have won this battle yet. The energy that was moving the market before this sideways zone has not disappeared. It has been absorbed, concentrated, and stored inside this quiet stretch of price, exactly like a spring being pressed flat before it is released. The spring analogy is not decorative. It is the mechanical truth of what compression does to a market. An amateur looks at a flat chart and sees nothing to trade. A professional looks at the same flat chart and starts measuring the range. Let me tell you about Leo. Leo had been trading for 2 years, and his problem was not that he was undisciplined. He was patient. He had rules. He waited for setups. The problem was that every setup Leo waited for was a moving setup, a candle already in motion, a trend already underway, a breakout already in progress. Leo was always entering after the move had begun. His entries were late by design because he was trained to look for confirmation in movement rather than confirmation in stillness. Over 18 months, his average reward-to-risk ratio sat at 1.4 to 1, meaning for every dollar he risked, he made roughly $1.40 when he was right. Decent, but not enough to grow the account the way he wanted. Then Leo discovered compression setups. He spent 3 months doing nothing except backtesting what happened after price entered a compression zone on the 1-hour chart, then broke out with an expanding candle and rising volume. What he found changed the way he thought about the entire market. His average reward-to-risk ratio on compression breakout entries was 3.1 to 1, more than double what he was getting by chasing moving setups. His average stop-loss distance dropped by 63% because compression zones are tight by definition, which meant he could size larger at the same 1% account risk. His win rate climbed from 44% to 57% because compression breakouts have clear invalidation points. If price returns inside the range after the breakout, the trade is wrong and you exit immediately, before a small loss becomes a large one. Leo did not find a new market. He did not change his time frame. He did not change his risk parameters. He found the one place on the chart where the setup is already doing most of the work before he ever clicks buy. Now let's put numbers around why this matters, because the math here is not intuitive until you see it written down. Say you have a $10,000 account and you risk 1% per trade, $100, on every entry. On a standard entry where you are chasing a move that is already in progress, Your stop loss might need to sit 40 or 50 points away to give the trade room to breathe. That stop distance, combined with your $100 risk, limits your position size. But on a compression setup, where price has tightened into a range that is only 15 or 20 points wide, your stop sits on the far side of that tight range, 15 points away, not 50. Same $100 risk, smaller stop distance, which means a larger position size, which means when the breakout runs, as compression breakouts consistently do, you are holding more contracts through a larger move with the same amount of capital at risk. A 3-to-1 reward setup on a 50-point stop gives you 150 points of profit. A 3-to-1 reward setup on a 15-point stop gives you 45 points of profit on a position that is more than 3 times larger. The dollar outcome is nearly identical, but the risk is 1/3 the size. This is not a trick. It is what happens when you enter price at the point of maximum coil instead of the point of maximum movement. The tighter the entry, the larger the position you can hold without increasing your risk. Write that down. So why do most traders never learn this? Why do they spend years chasing moving candles and missing the very setups that professionals build their edge around? Because your brain was not designed for this. Dopamine, the neurotransmitter your brain releases in response to reward and the anticipation of reward, fires hardest in the presence of movement. A candle shooting upward triggers your brain's reward system before you have even placed a trade. It creates urgency. It creates the feeling that this moment is special, that this particular candle is the one you cannot miss. A flat, sideways compression zone triggers almost nothing. Your brain reads stillness as absence, as emptiness, as an absence of opportunity, and so it moves the cursor down the screen in search of something that is already moving. This is the same neurological pattern that makes gamblers bet more after watching someone else win at the table. The brain wants to be where the action already is. Professional traders spend years rewiring this response, not because they are more disciplined than everyone else, but because they have done the math often enough to know that the moving candle is rarely the opportunity it appears to be, and the still candle is rarely as empty as it looks. An amateur chases the candle that is already moving. A professional waits for the candle that is about to move. Here is the protocol. 7 steps. Apply them in this exact order. Step 1. Identify the prior trend. Compression is only meaningful in context. A dead zone that forms after a strong directional move, a significant rise or fall, is carrying the energy of that prior move inside it. A compression zone that forms with no clear prior trend on either side is not a setup. It is genuinely sideways noise. Context first. Always. Step 2. Confirm the range is shrinking across at least 7 consecutive candles. Not one small candle, not 2. You are looking for a visible pattern where the distance between each candle's high and low is contracting over time. Price is being pressed flat. If the range is not clearly narrowing, the compression has not formed yet. Wait. Step 3. Check volume inside the compression zone. Volume should be declining as price tightens. This confirms that the market is not distribution, it is accumulation. Sellers are not rushing to exit. Buyers are not rushing to enter. Both sides are waiting. That balance is exactly where the energy builds. Step 4. Draw 2 horizontal lines, one across the highest point inside the compression zone and one across the lowest. These are your trigger lines. The market is about to tell you which direction it chooses. Your job is to mark the choice points before the decision is made. Step 5. Wait for a breakout candle that closes clearly beyond one of your trigger lines and is visibly larger than the candles that formed inside the compression zone. The body of this candle should be at least twice the average size of the bodies inside the range. This size difference is not cosmetic. It is the market's way of showing conviction. Small candles show indecision. Large candles show a decision has been made. Step 6. Confirm the volume on the breakout candle is higher than the average volume inside the compression zone. A breakout on expanding volume is a real move. A breakout on shrinking volume is a trap. Volume is not optional confirmation.
It is the confirmation.
Step 7. Place your entry on the close of the breakout candle, your stop loss on the opposite side of the compression range, and your first target at a distance equal to the height of the prior trending move that preceded the compression. This is your measured move projection, and it is the reason compression breakouts consistently produce reward-to-risk ratios that standard entries cannot match. One signal, 7 steps, every time. An amateur sees the breakout and asks why they missed it. A professional saw the compression first and was already positioned. You have been scrolling past the best entries on your chart, not because they were hidden, not because they required a complex system to find, because they did not look like what your brain told you an opportunity was supposed to look like. They looked flat. They looked quiet. They looked dead. And the market was using exactly that appearance to sort the patient from the impatient, the professional from the amateur, the trader who has learned to see from the trader who is still only looking. The dead zone is not where the market rests. It is where the market decides. Compression creates precision. Precision creates confidence. Confidence creates the entry that doesn't need to be moved, widened, or second-guessed the moment price tests you. The next time you see price go flat, the next time the chart looks like nothing is happening, do not scroll past it. Open a new chart, draw your trigger lines, watch your volume, and wait for the spring to release. Because the traders on the other side of that breakout are not lucky. They were still enough to be there when the market finally moved. If this shifted how you look at a flat chart, if you have been skipping compression zones without knowing what you were walking past, type dead zone in the comments. And subscribe now because the next video shows you exactly how professionals combine the compression signal with the volume signals we covered last time to build a complete rules-based entry checklist that removes guesswork from the trade entirely. The chart never lied to you. It was always showing you this. You needed to know where to look.